Hey, what's up, guys? So this session, we plan to review chapter 3 and 4. Chapter 3 mainly talks about how securities are traded in the market, while chapter 4 is about the mutual fund industry. Chapter 3, how securities are traded, problem 1. This is from BKM, problem sets number 3. So how do margin trades magnify both the upside potential and the downside risk of an investment position? So what the question is about is that margin trades is directly linked to leverage, as we talk about it. So the use of leverage is mainly about borrow money and shares to magnify your return. But also know that if the market reverses, the loss will be bigger because you not only need to calculate your own loss, you have also to pay back your broker. So the loss will be bigger if the market reverses. So the use of leverage necessarily magnifies returns to investors. Leveraging borrowed money allows for greater return on investment if the stock price increases. However, if the stock price declines, the investor must repay the loan regardless of how far the stock price drops and incur a negative rate of return. For example, if an investor buys an asset at $100 and the price rises to 110, so the return would be 10%. If he or she takes out a $40 loan at 5% interest rate, or we can call it margin rate, and buys the same stock, the return will be 13.3% in detail, which is you have $10 capital gain, but you have to pay your broker $40 times 5% interest, so it's $2 interest expense. So your net gain is $8, which is 10 minus 2, and you have to divide it by the $60 original investment or your own margin, your initial margin. Of course, if the stock price falls below $100, the negative return will be greater for the leverage account because you have to first calculate your own loss, and then you still have to pay the $2 interest. Number 4, market order. A market order has A, price uncertainty, but not execution uncertainty. B, both price uncertainty and execution uncertainty. C, execution uncertainty, but not price uncertainty. So a market order has has price uncertainty because the order is executed to the market price. While the limit order, on the other hand, has no price uncertainty but execution uncertainty because you limit the price. So a market order is an order to execute the trade immediately at the best possible price. So price is not priority. Execution is priority. The emphasis in the market order is the speed of execution, the reduction of execution uncertainty, as we talk about it. While the disadvantage is sure that you don't know what price you'll get. So a market order is at the price at which it will be executed is not known ahead of time. It does has price uncertainty. So in the following, I will illustrate the market bid and ask to you. So in the market, there is ask 5, ask 4, ask 3, ask 2, ask 1, and in the below, this is bid 1, bid 2, bid 3, bid 4, bid 5. So if it's a market order, whether you put up an ask order or a bid order, whether it's 1, 2, 3, 4, 5 or 1, 2, 3, 4, 5, you will always get the 1 because this is the most immediate most immediate transaction, which means you get market price. But in a limit order, you can insist on ask 5 because you, like, by your own judgment, you predict that ask 5 will be ask 1 after a period of time, and in that case you will gain or you won't lose. You will lose less in this transaction. So I hope this chart will give you a basic idea of how the limit order and market order works. Number 5, where would an illiquid security in a developing country most likely trade? Note that in this question it says illiquid security. So if it's illiquid security, how will you trade it? The best way is to call your counterparty or your trading buddy. Yeah, a phone call is the best way to sell or buy an illiquid security. Well, what is this kind of market? It's called a broker market. A broker market consists of intermediaries who have the discretion to trade for their clients. A large block trade in an illiquid security would most likely trade in this market, as the brokers would have the best access to clients interested in this type of security. Well, if you need to make a phone call, you are using your network, and which institution has the best network? That is the broker. So this is a basic idea, and this is the formal definition. The advantage of an electronic communication network, which is also called electronic crossing network, is that it can execute large block orders without affecting the public quote. Since this security is illiquid, large block orders are less likely to occur, thus it would not likely trade through an ECN. So what is mainly trade through ECN? The interbank offering market will use ECN very often. Just in addition, in this formal definition, why do we need a broker? Because a broker can do a perfect job in the activity called book subscribing. This is used in IPO and also in secondary market. So if it's over subscribed, we can know that it's in high demand. The last one is electronic limit order markets. This market transacts securities with high trading volume. The illiquid security is unlikely to be traded on an E-long, because if you use limit order, in this graph we can see that you insist on ask 5, ask 4, or bid 3, bid 4. You don't care about the market price. You have your own judgment. But sometimes the market only trades on ask 1 and bid 1. So for an extreme illiquid security, it's not a good idea to insist on your own view if you want to trade it. It's better if you follow the market. Number 6. So number 6 and number 7 are very, very important calculations, and I hope you guys have a better idea if you can go through it, go over it again. Number 6, the trader opens a brokerage account and purchases 300 shares of Internet Dreams at $40 per share. She borrows $4,000 from her broker to help pay for the purchase. The interest rate on the loan is 8%. A, what is the margin in this account when she first purchases the stock? So the margin is his initial equity. So the stock is purchased for 300 shares and $40 per share, so it's $12,000. The amount borrowed is $4,000. Therefore, the investor put up equity, or his margin, initial margin or initial equity, which is $12,000 minus $4,000, and it's $8,000 equity or margin, which is initial equity or initial margin. If the share price falls to $30, then the value of the stock falls to 300 shares times $30. The value is $9,000. By the end of the year, the amount of the loan owed to the broker grows to, this is the amount he or she borrows, and this is principal plus interest rate. So this is the total amount he or she would pay back. So it's $4,320. Therefore, the remaining margin in the investor's account is So the value he or she holds is $9,000, and he or she has to pay back the broker when the time comes is 4,320. So at this time, the remaining margin or remaining equity of the investor is $4,680. So the percentage margin is now this number over the total equity now. This is now, and this is initial. There's a big difference. So now the margin, percentage margin is 52%, which is pretty safe. It's not pretty safe. I should say it's comparatively safe. And we can see that if the maintenance margin requirement is 30%, will she receive a margin call? The answer is no. She will not receive a margin call because 52 is greater than 30. The rate of return on her investment over the year. So now we need to use the initial investment, which is the initial equity or initial margin, which is the ending equity in the account minus the initial equity over the initial equity. So now the remaining equity is 4,680. But initially she put in 8,000. So the return is minus 41.5%, which is she lost 41.5%. So in this case, we can see that if you put on a leverage, which is $4,000 in the $12,000 you want to invest, the loss or the rate of return, the net rate of return, will be magnified because for the stock price, if you don't have leverage, when the stock drops from 40 to 30, your loss should be 10 over 40, which is 25. But now this is 41. So the loss is magnified. Alternatively, you can also calculate the rate of return by dividing the initial equity investments into the change in value plus the interest payment. So when the stock price drops from 40 to 30, the loss is from $12,000 to $9,000, which is $3,000 loss. And still, you have to pay back your broker the 320 interest. So the net loss. So the net loss over initial investment is your rate of return, which is 41.5% loss. Number 7 is the same, but now the investor sells short. If you want to long the position, position with margin, you have to borrow money. You need to short the position with margin you need to borrow stocks or borrow shares. So number 7, old economy traders open an account to short sell 1,000 shares of internet dreams from the previous problems. The initial margin requirement was 50%. The margin account pays no interest. This is assumed. Assume the margin account pays no interest. A year later, the price of internet dreams has risen from $40 to $50, which is a disaster since you are shorting the stocks, shorting this stock. And the stock has paid a dividend of $2 per share, which makes it even worse because you have to pay back your broker since you borrow shares from the broker, and now the stock get dividend. So you should give the dividend back to the broker. So A, what is the remaining margin in the account? To calculate the remaining margin, we need to first calculate the initial margin. So initial margin was 50% margin rate, and you short 1,000 shares at $40. So the initial margin should be $20,000. And the margin account pays no interest, so it's $20,000. As a result of the increase in the stock price, this is $10 loss. If you want to close your short position at 50, you have to buy back the shares at $50, which is a net loss of $10 times the 1,000 shares, which is $10,000 loss. Therefore, the margin decreases by 10,000. Moreover, old economy traders must pay the dividend of $2 per share to the lender of the shares, so that the margin in the account decreases by an additional 2,000. Therefore, the remaining margin is your initial margin, the money you put in, minus you have to put $10,000 more to buy back your shares and $2,000 to pay back your broker. So the remaining margin is only $8,000. And now the percentage margin is $8,000 over your total equity. Now, if you want to close the position. So if you want to close your short position, so now the stock is worth $50,000. So now your percentage margin is only 16%. And if the maintenance margin requirement is 30%, you will surely get a margin call. C, what is the rate of return on the investment? The equity in the account decreased from 20,000 to 8,000 in 1 year for a rate of return, which is a net loss of $12,000 over the initial investment, which is $20,000. So now the rate of return should be minus 60%, which is a huge loss because you use the leverage. Because you use the leverage, the return should, the loss is huge. So please be sure that when you calculate the rate of return, it's always your net gain or loss over your initial investment, which is the money you put in. Number 14. Here is some price information on FinCorp stock. Suppose that Financial Corp trades in a dealer market. The bid price is $50.25 and the ask price is $55.5. Suppose you have submitted an order to your broker to buy at the market. At what price will your trade be executed? You want to buy, so your counterparty is the ask. So dealer will charge you 50.5%. I'm sorry, $55.5 per share. Suppose you have submitted an order to sell at the market. So now your sale is your broker or your counterparty's bid. So you'll get $55.25 per share. Suppose you have submitted a limit order to sell at $55.62. What will happen? It's a limit order to sell. If you want to sell, your counterparty is the bid, but you want to sell a higher price, higher than the bid price, so there will be no trade. The trade will not be executed because the bid price is lower than the price specified in the limit sale order. D, suppose you have submitted a limit order to buy at $55.37 per share. What will happen? If you want to buy, your counterparty is the ask, but your counterparty certainly ask a higher price than the price you are willing to pay. So this trade will not be executed because the ask price is greater than the price specified in the limit buy order. Number 15. You've borrowed $20,000 on margin to buy shares in Disney, which is now selling at $40 per share. Your account starts at the initial margin requirement of 50%. The maintenance margin is 35%. 2 days later, the stock price falls to $35 per share. A, will you receive a margin call? You will not receive a margin call because you borrowed you borrowed $20,000 on margin with another $20,000 of your own equity, because the initial margin percentage is 50%. And you can buy 1,000 shares of Disney at $40 per share. So now if the stock price falls to $35 per share, the market value of the stock is $35,000, which is 35 times the 1,000 shares. Your equity is 15,000 shares because the $5,000 loss will be on you instead of on the broker who lent you money. You have to pay back the principal with interest when the deal closes. So your equity is now only $15,000 because you take the whole loss of $5,000. And the percentage margin is now 15,000 over 35,000, which is now the market value of the stock. And the percentage margin is 42.9%, which is greater than 35%. So you will not receive a margin call. And when will you receive a margin call? We can set the price as P the current price of the stock as P. So this is the loss when the price drops to P, and you have to take the whole loss. And this is your remaining equity. This is your remaining equity over the market value or the current equity. In the last case, this is $35,000. And when you receive a margin call, the percentage margin should be 35%. And we can solve for P, that P is $30.77 per share or even lower. In this case, you will receive a margin call from your broker. CFA problems. Number 2, if you place a stop loss order to sell at 100 shares of stock at 55 when the current price is 62, how much will you receive for each share if the price drops to 50? So if you place a stop loss order for the stop loss order at 55, this is like a limit order, but it also incorporates the market order features. Which means that if the market price falls below $55, you want to sell as much as possible of the 100 shares. You want to sell them all. But if you continue to sell, if the sale continues, the price will drop even further, right? So what will happen? What will happen now for this stop loss order? This order, the remaining order will be executed at the best possible market price, which is the exact meaning of stop loss. So how much will we receive for each share if the price drops to 50? We don't know, because if you continue to sell, the price will drop even further. So the remaining order will be executed at best possible market price. So the broker will continue to sell at current market price after the first transaction at $55 or less. This is an execution priority of the stop loss order. Next, we'll review the E investment exercise. You can find it on the book of BKM, which is mainly about reviewing this list, which is called Barron's Online Broker Survey 2016, how they stack up. We can see that the major online brokers are listed on this website, and this is a thorough comparison of the fee, of the structure, of the services, and yeah, all of the information you want to compare between those online brokers. Online brokers. You can find it here. Number 1, are all of the brokerage firms suitable if you want to open a cash account? Are they suitable if you want a margin account? So not all of the firms are suitable if you want to open a cash account. For example, Interactive Brokers requires $10,000 minimum to open cash account. In this case, you want to put it in a non-IRA account, so this is not for the retirement. So the interactive brokers requires $5,000 minimum for IRA account and $3,000 minimum if you're under age 26. Are they all suitable if you want a margin account? Yes, if you want a margin account, because the account minimum is $2,000 for opening a margin account at all brokers. This is a regulatory requirement, so this is universal for all of the brokers, the online brokers. Number two, choose two of the firms listed. Assume that you want to buy 2,000 shares of LY stock using a market order. If the order is filled at 42 per share, how much will the commission be for the two firms if you place an online order? So note that commission for most online brokers is flat rate, which is like on this website, on this Baron website, it ranges from 1.88 to $8.9 per trade. So it's a flat rate no matter how much shares are in each trade. If you place only one order, no matter this is a market order. So the cost per trade is the commission listed above. We can see that market order, no. Limit order, no. Commission, yes, commission. We can see that commission per order for Charles Schwab, this is 8.95 per order. But for interactive brokers, it's only $1 per trade or per order. Number three, are there any maintenance fees associated with the account at either brokerage firm? Yeah, there is some maintenance fees. For example, E-Trade charges $50 for inactive accounts. This is a kind of maintenance fee. Number four, now assume that you have a margin account and the balance is $3,000. Calculate the interest rate you would pay if you borrow money to buy stock. So if you want to calculate the interest rate, you don't actually need to calculate it. You just need to look for the margin rate. So margin rate is the interest rate you borrow from your broker. Most brokers charge 5 to 7% margin rate. So if your borrowing balance is $3,000, you first multiply it by the margin rate, calculate the cost to your holding period, and then you will get the interest you need to pay when you close the deal. For example, margin rate for $10,000 balance or below at Charles Schwab is 8.5%, which means that if you borrow for a year, it's typically not this long. You will be paying 3,000 times 8.5, which will give you the total interest. So the interest rate you will pay is 8.5 for Charles Schwab and under $10,000 balance. Now let's come to Chapter 4. Chapter 4, Mutual Funds and Other Investment Companies. Number 2, What are some comparative advantages of investing in the following? A, unit investment trust. So what is an is a unit investment trust? This is diversification from large scale investing. It has lower transaction costs associated with large scale trading, low management fees, predictable portfolio composition, and guaranteed low portfolio turnover rate. This is more yeah, this is a trust. B, open-end mutual funds. The advantages are diversification from the comparative advantage of open-end mutual funds is that diversification from large-scale investing, which is the same as unit investment trust, lower transaction costs associated with large-scale trading, professional management that may be able to take advantage of buy or sell opportunities as they arise, and they do a good job in record keeping. C, individual stocks and bonds that you choose for yourself. Of course, there is no management fee. You use your own judgment. You have the ability to coordinate realization of capital gains or losses with the investor's personal tax situations. We always observe in December there is much more selling activity than in other month of the year. So this is mainly because you have to consider your tax according to your capital gains or losses. If you sell and you realize your loss, you will pay less taxes. And you also have the capability of designing portfolio to investors' specific risk and return profile because you know yourself the best. The fund, your broker, they don't know exactly what is your risk appetite and what is your return, your required rate of return. Number 3, open-end equity mutual funds find it necessary to keep a significant percentage of total investment, typically around 5% of the portfolio, in very liquid money market assets. This is the best way to cope with redemption demand. You need to hold cash equivalent assets. Otherwise, when the redemption demand rises, that will be a disaster. Open-end funds are obligated to redeem investors' shares at net asset value and thus must keep cash or cash equivalent securities on hand in order to meet potential redemptions. Closed-end funds do not need the cash reserves because there are no redemptions for closed-end funds. Investors in closed-end funds sell their shares when they wish to cash out. So this is the difference between open-end funds and closed-end funds. Number 4, balanced funds, life cycle funds, and asset allocation funds all invest in both the stock and bond markets. What are the differences among these types of funds? So balanced funds keep relatively stable proportions of funds invested in each asset class. They are meant as convenient instruments to provide participation in a range of asset classes. Life cycle funds are balanced funds whose asset life cycle funds is also a kind of balanced funds, but as the name indicates, it's marketed according to life cycle. It's marketed according to life cycle. So life cycle funds are balanced funds whose asset mix generally depends on the age of the investor. Aggressive lifecycle funds with larger investments in equities are marketed to younger investors, while conservative lifecycle funds with larger investment in fixed income securities, which has long mature date, I should say, because sometimes you need to match the maturity, but it's not necessarily always the case. So insurance firms are the major buyer of real estate and 30-year bonds. 30-year, not bonds, I should say treasury bills. So they are designed for older investors. Asset allocation funds, in contrast, may vary the proportions invested in each asset class by large amounts, as predictions of relative performance across classes vary. Asset allocation funds is the more aggressive type among the three kind of funds. Number 5, why can closed-end funds sell at prices that differ from net asset value while open-end funds do not? This is called the closed-end fund puzzle. Unlike the open-end fund in which underlying shares are redeemed when the fund is redeemed, a closed-end fund trades, it cannot be redeemed. As a security in the market, so the price will depend on market demand and supply. So their prices may differ from the net asset value, which we call as the closed-end fund puzzle. And many traders will use this trick to arbitrage. Number 6, what are the advantages and disadvantages of exchange-traded funds versus mutual fund? This is ETF, and this is normal mutual funds. An ETF is better over a mutual fund in the sense that ETFs are continuously traded and can be sold or purchased on margin, which is good. If you purchase on margin, it will magnify your return if you predict it right. There are no capital gains tax triggers when an ETF is sold. And investors buy from brokers, thus eliminating the cost of direct marketing to individual small investors. This implies lower management fees. It's basically a stock, like a share of a stock. So the disadvantage of an ETF over a mutual fund is that prices can depart from net asset value, unlike an open-ended fund, because ETF is closed-ended. And there is also a broker fee when buying and selling, because this is like a stock. If you want to trade it, you need to it will incur a broker fee. Number 9, the composition of the Fine Group fund portfolio is as follows: stock A, B, C, D, and respective shares and respective price. So what is the net asset value of the fund? the total asset value, if we times the share by the price, you'll get A, B, C, and D in dollar amount, and the total is $42 million. But it's accrued a management fee with the portfolio manager currently totals $30,000. So the net asset value is the total asset value minus the management fee over the total shares. Yeah. I'm sorry. Oh yeah, there are 4 million shares outstanding. So this is 4 million shares outstanding of this fund. This is the share the fund holds, and the 4 million share is the fund issue. So this is different. This is the share in the fund's portfolio, and this is the share the fund issues to the investors. So the net asset value per share is $10.49 per share. Number 18. Number 18 is an interesting question. You purchased 1,000 shares of the new fund at a price of $20 per share at the beginning of the year. You paid a front-end load of 4%. So what is a front-end load? So a front-end load, excuse me, the front-end load is the percentage you pay to enter the market or enter the fund. Most of the people will calculate the rate of return by using the return, the gross return, 12% minus the expenses, 1.2%, and minus the front end load of 4%, gives you 6.8%. But this is not your actual return. This is an approximate rate of return. The actual return is less than this because the 4% front end load is paid upfront, not at the end of the year. So the principle is different. Now, to purchase the shares, you would have had to invest, if we consider the 4% upfront, the 4% fees you paid upfront. If you want to buy 1,000 shares at $20, you actually need to put in $20,833. So it's more than $20,000. At the end of the year, the shares increase in value from $20,000 to 20 times the gross return minus the expenses, which will give you $22,160. So now we use these two numbers to calculate your rate of return. So your rate of return is the current value, current net value, minus your initial investment, the initial money you put in, and over your initial investment. And this will give you 6.37% rate of return. It's pretty close to 6.8%, but it's not 6.8. So this is chapter 3 and 4. It's a long chapter, but it's very important for you to get a grasp of the stock market and the mutual fund market. I hope you guys enjoy. See you next time.